Okay, so in chapter 11, we're going to be talking about the time value of money. And this is a concept that I find can be a little bit frustrating, a little bit confusing. So I'll try to make time for us in class to walk through some examples in class. I will tell you right now, though, one thing that will make these exponentially less infuriating will be to have a financial calculator. Okay. So the first thing we got to talk about really to start beginning to understand the concept of time value of money is the relationships between risks and return. Okay. So we use time value of money as a way to help us make decisions about whether we should be borrowing money. And remember, that's like a financing activity. Should we be selling debt securities like bonds? Should we be taking out notes from the bank? So remember, those are financing activities. We're trying to raise capital. We are financing the capital of our business. Or we use TVM as well to make decisions about, do we buy this long-term asset? If it's going to cost us this much, do we think the cash flows in the future justify the purchase? These are investing activities. Remember, investing activities are going to be mostly associated with long-term asset acquisition and disposition. So the first thing we want to talk about really is the difference between the return of investment and the return on investment. Okay. So for example, let's say you invest $1,000 and later on after a year, 2 years, whatever the case is, it becomes $1,150. So the $1,000 you get back is the return of your investment. You're getting a return of the capital of $1,000. The $150 in addition that you got to your initial investment, that's your return on the investment. Okay. So we use common measures, and we'll talk about this again on the next slide, but we're going to use a common measure called a rate. Okay. So one thing you may ask yourself is, would I rather have $50 in 1 year or $60 in 2 years? While $50 is less than $60, the $50 is greater than the $30 that you would get once a year for 2 years. You're just getting that $50 once in 1 year. And that $50 this year, using the concept of time value money, is going to be worth more than the $30 next year. Okay, so I just mentioned that we talk about common size measurements, and return on investment is a common size measurement. It is the rate of return. We don't want to know the actual amount. We simply want to know what is the rate of return. And this next question is a good example of that. So, is it better? Would you rather have a $1,000 return on a $10,000 investment, or would you rather have a $10,000 return on a $1 million investment? Okay. The rate of return is going to assume a single year, a 1 year investment. So the way we find our rate of return is we're going to take the amount of return on investment and divide that by the amount of the investment. So the $1,000 return on the $10,000 investment is 10%. The $10,000 return on the $1 million investment is 1%. So here we would say, if we're looking just at the rate of return, we would probably want to take the $1,000 return on the $10,000 investment. Okay. Note, though, that you can have a negative return on investment. So let's say, for example, you invest $1,000 and you get $980 back. You would have a negative 2% return on your investment. You're going to see this in places like the stock market, where your investments become extremely volatile, right? So now let's talk a little bit about the relationship between risk and return and a calculation of those relationships. What makes risk? Well, it's the uncertainty, right? The uncertainty that there is a possibility of an undesirable outcome occurring. That is the uncertainty. That is the risk. Okay, so the expected rate of return is going to take into consideration that risk. Okay, all it really is the weighted average of possible rates of return. You need to know, though, that the percentages have to add up to 1. If they don't, it means there is some other risk out there, right? So the percentages have to add to 1, and you'll see that they do here. So let's look at two different investments here. We've got investment A. It's a $100,000 investment. Okay, the probability of getting a return of $10,000 is 20%, $5,000 is 50%, $2,000 is 3%. So what we're going to do is we're going to find our expected return, which is going to be the percentage of each possible return. Okay, and then we'll see that that's $4,800. What is our expected rate of return? Well, our expected return is $4,800. Our investment is $100,000. So we've got a 4.8 expected rate of return. Okay. Now, investment B, we've got a probability of getting a return of $30,000, a 30% return on of 20%. Then we've got a possible return of $5,000 occurring at 50%, and a possible negative return of $4,000 of 30% here. Okay, so our expected return would be $7,300, making our expected rate of return 7.3. Here's the question, and this is where your management style is going to come into play. Which investment do you choose? Do you choose A or do you choose B? Most accountants are conservative, a little bit risk adverse, so they may choose option A, investment A, because you can't lose, right? You're going to get a positive return here based on your expectations and your calculations. You should get a positive return there, so the risk of losing is very, 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 very slim to none. Whereas with investment B, you could hit a good payday, a 30% return on your investment. You've got a 20% chance of that occurring, but you've also got a higher 30% chance of losing money on it. So it really just depends. Are you risk adverse, or what is your risk appetite? Okay, are you willing to risk it to get that higher rate of return? This is just a really quick kind of compilation of what makes up our risk. So the first one we got here is inflation risk, and that's just the inflation in the economy. So if you're expecting a 2% return and there's 10% of inflation in the economy, you've got to factor that 10% in, right? You need to be looking for 12% returns. Otherwise, you won't break even on it. Then you have business risk. This can be controlled by the business, right? This is their risk appetite. And then you have liquidity risk. Kind of one of the best ways to think about this is you own a car right now. Most of you may own a car. Think about how much you could get for that car if you went to sell it. Well, the difference there is, what if I told you needed to sell that car in the next hour? Do you think you could get that same amount of cash for that car? Probably not. And that's liquidity risk. Just because you have the asset doesn't mean you can turn it to cash that quickly. Okay. Most of the time, the liquidity risk comes from the stock market, right? So if you have a stock that's tanking, it's not very liquid. You're going to have trouble selling it. So think of it that way. When you are looking to get your desired rate of return, you need to take all of those risks into consideration, plus what we call the risk-free rate. Essentially, the risk-free rate of return is the expected rate of return on investment with no risk involved at all. Okay. Typically, what they're going to use to find this rate is the return rate on a 3-month treasury bill, because they're so safe. They typically consider those to be your risk-free rate of return. Now, we got to talk about simple versus compound interest really quickly. Most of you probably already familiar with this, so we're not going to spend a ton of time on it. Okay. One thing I do want to draw your attention back to, though, is the formula, the ART formula. Your amount times your rate times your time. That is the way we're going to calculate interest in this class. We've already learned this. We've calculated many different types of interest with it in this class: interest expense, interest payable, that kind of thing, interest on notes. Here we're going to think about interest on our investments. So simple interest is when the interest is only ever calculated on the principal amount. Okay. So let's say, for example, you invested $100,000 on 1/1/24. You invested for 3 years at 1% simple interest. The return on that would look like this table right here. You would get $10,000 a year in interest income because you're only ever calculating your interest off of the initial principal, right? So you would get a return on investment of $30,000. That's your total interest income you earned. Then you would have a return of investment, the return of the principal, of $100,000. Okay? Now this is where the magic is actually happening, right? This is compound interest. Warren Buffett, very famous billionaire, has said that, compound interest is magic. It's the magic of compound interest. Okay? Essentially, compound interest is simply interest on the interest. Okay? So it's going to be interest on the interest and interest on the principal. Essentially, each period's interest is added to the principal prior to calculating the new period's interest. So we can look at the table below. Let's assume the same things we talked about earlier. $100,000 we invested on 1/1/24 for 3 years. 1% compounded interest yearly. Okay, this is what the schedule is then going to look like. So year one, we're going to get a 1%. We'll get a 10% increase in interest here. That's a $10,000 interest income. Then on 12/31/26, we're going to add that $10,000 to the $110,000 principal, multiply it times 10%, and you're going to get $11,000 worth of interest that year. Then you're going to add that interest to the principal again the next year and calculate your new interest rate, giving you $12,100. Here we can see our return on investment is greater than we had with just simple interest. In fact, it's about 33% more than what we calculated with just simple interest. Okay, return of investment is the same. It's our return on investment that changes. Okay? You need to know that the compounding period can be more frequent than every year. Okay, so for example, we'll assume the same facts. $100,000 invested at on 1/1/24 for 3 years at 10% compounded interest. We're going to compound it semi-annually. That means we are going to calculate the interest twice a year. Okay, so here we look on 6/30/24. Take the initial principal, the initial investment, multiply it times 10% times our 6/12. That's the N over 12, right? And $5,000 worth of interest. We add that amount of interest to the principal, and then at the end of the year, 6 months later, we calculate it again. And you just keep doing that until you finally, until the investment matures. In which case you have a return on investment, your total interest income of $34,009.56, and you have a return of your investment of the initial principal investment, which is $100,000. Okay, so I'm going to cut the video off here. The next video we will talk about the actual time value of money calculations. There are 4 of them that you'll want to know. Again, I'll just reiterate the fact that you should probably go and look for a financial calculator to use that will make these time value of money calculations much, much more simple.